Every night on the news, we hear the same thing. The stock market hit another record today. But have you ever wondered what that actually means? If the market keeps going up, why don't most people feel richer? Why have wages barely moved for decades while stock prices keep breaking records? To understand this mystery, we need to understand what the stock market is really measuring. When the stock market is rising, people often assume the entire economy is doing great. For decades, headlines have suggested that a booming market means a booming country. Many commentators claim that the stock market reflects the health and prosperity of the economy. But when you look closer, something strange appears. The total value of goods and services produced in the United States has not been growing as quickly as it once did. Wages for many workers have stayed nearly the same for years, and many families still have not recovered financially from the last major recession. So, if the real economy isn't growing that fast, what exactly is the stock market measuring? To understand this, imagine a very simple business, a lemonade stand. Jill runs a lemonade stand that is doing really well. She wants to expand and open more stands, but the bank thinks the idea is too risky and refuses to give her a loan. Instead, Jill decides to try something different. She sells small pieces of her company to investors. This is called an initial public offering, or IPO. Anyone who buys a share becomes a partial owner of Jill's business. If the business grows and becomes more profitable, those shares become more valuable. The money Jill receives from selling shares allows her to open more lemonade stands and grow her business. When the business earns profits, she can choose to share some of that money with investors. These payments are called dividends. But investors don't always make money from dividends. Sometimes they simply buy shares because they believe the company will become more valuable in the future. If someone thinks Jill's lemonade business will become huge, they might buy a share today for $1 and later sell it to someone else for $2. That buying and selling is the stock market. People trading tiny pieces of companies based on what they believe those pieces will be worth in the future. In the real world, this process happens thousands of times every second across the globe. There are stock markets in many countries, but two of the most famous in the United States are the New York Stock Exchange and the NASDAQ. The New York Stock Exchange is one of the oldest financial markets in the world. It began in 1792 when a small group of stockbrokers agreed to trade shares under a tree on Wall Street. Today, it lists many large and traditional companies. NASDAQ, on the other hand, was created much later and operates electronically. Many technology companies are traded there. But with thousands of companies trading shares every day, how do people quickly understand how the market is performing? That's where indexes come in. Indexes combine the prices of many companies into a single number. The S&P 500 tracks 500 of the largest companies in the United States. The Dow Jones Industrial Average follows only 30 major companies that are considered extremely influential. When these numbers go up, people say the market is rising. When they fall, people say the market is down. But stock markets didn't always play such a central role in the economy. In the early days of industrial business, many large companies were controlled by a single powerful owner. Over time, businesses realized something important. If they allowed the public to invest, they could raise huge amounts of money and expand much faster. This idea helped create the modern public corporation. Investors provided capital, companies grew larger, and many people benefited. After World War II, this system helped build a strong middle class. Corporations created stable jobs, produced innovative products, and expanded around the world. Executives often believed they had responsibilities not only to shareholders, but also to employees, communities, and customers. For many years, this balance worked well. But eventually, a new idea began to dominate business thinking. The idea was simple. A company's main responsibility should be to maximize profits for its shareholders. Under this philosophy, corporate leaders started focusing heavily on stock prices. Executive salaries became tied to the performance of a company's shares. If stock prices rose, executives earned enormous bonuses. As a result, many companies began making decisions designed to increase stock prices quickly. They cut costs, reduced staff, and focused on short-term profits. Another common strategy became stock buybacks. Companies would spend large amounts of money buying their own shares from the market. This reduced the number of shares available and often pushed prices higher. But money used for buybacks or dividends could no longer be invested in raising wages, developing new products, or expanding operations. This shift changed the way corporations behaved. Instead of focusing on long-term growth, many began prioritizing short-term financial gains, and that had consequences. Sometimes, companies closed factories or laid off workers simply to increase profits and boost their stock prices. While these decisions could make investors happy, they often harmed employees and communities. Meanwhile, as stock markets continued rising, wealth became more concentrated. A smaller portion of the population owned most of the stocks. As stock prices increased, the richest investors gained enormous wealth, while many ordinary workers saw little change in their incomes. This is one reason why economic inequality has grown alongside the rising stock market. But the story doesn't end there. Stock markets themselves are not necessarily bad. They allow companies to raise money, support innovation, and help new ideas become reality. They also give individuals the opportunity to invest in businesses and grow their savings. In many successful countries, stock markets play an important role in economic development. But the impact of the market depends on how companies and investors choose to use it. Shareholders ultimately influence corporate behavior. If investors demand only short-term profits, companies will focus on short-term gains. But if investors care about long-term stability, fair wages, and responsible business practices, companies can move in that direction as well. In the end, the stock market is not simply a machine that measures economic prosperity. It is a reflection of expectations, beliefs, and decisions made by millions of investors. And those investors have the power to shape the future of the economy itself. The market may measure the price of companies, but the values of society decide what those companies actually do.